Hey guys, Sean here. We have entered a bear market and it's going to be one of the biggest in history. Everything is in a meltdown. The S&P is down over 20%. Bitcoin has fallen by 55%. The bond market is getting decimated and even precious metals are getting hammered. Now, this is not an ordinary sell-off. This is not a correction. This is a market that is filled to the brim with fear and everyone is in panic mode. We have never seen so much selling pressure before and the bears are in full control of this bloodbath. Now, we are in a perfect storm where inflation is soaring, rates are going to be hiked aggressively, and a massive liquidity crisis is going to get worse over the next few months. Right now, we are seeing people exiting anything remotely associated with risk. If he has the word technology or cryptocurrency in it, it is all crashing to hell. Now, we are witnessing the collapse of the riskiest assets first. Companies like Celsius that were promising high returns out of nowhere suddenly getting exposed when people started to do a bank run and withdraw their money on them. Now it's a done deal, there's a panic in the markets and blood is truly flowing down Wall Street. And if you believe it's just going to stop here and the markets are just going to bounce right back up and go into the green and rally to all-time highs, you might need to rethink your conviction. And in this video, we have to go through why there's still severe downside left in the markets. We are talking about an additional 20 or 30% easily left in this collapse. Now, people today are literally fearing if they have enough money to make it to tomorrow, they don't have enough money to spend outside of food and gas, and this is reflected across every single asset class that is imploding today. Now, let's get one thing straight. This collapse has been engineered for decades. If we take a look at the 10-year yield, we have reached 3.5%, the highest in 11 years, and at the same time, the S&P 500 is getting smashed down to new lows. Now, what does this tell us? Money is leaving the system. People are losing confidence in their entire financial system. They don't trust equities, they don't trust bonds, they rather run to cash and suffer 8.6% inflation hit. Now, this is extremely concerning because the debt market controls the stock market to a huge extent, which I'll cover in just a bit. But here's the truth. This collapse has been engineered for quite some time. It wasn't just because of the war in Ukraine or the surge in oil price. Yes, those were likely the triggers, the final straws on the camel's back that sent this whole house of cards crashing down to earth. But all this has to do with the Federal Reserve and how they have turned the stock market and financial markets in general into a casino gambling den thanks to their monetary policies. And I'm specifically talking about money printing and low rates. Now, I want us to take a look at the classic market bubble chart. We all know this. This is how market cycles happen when we get to a bubble. Now, the smart money comes in early. Institutions build up their positions, the public then piles into the market and beats everything up, and then everything collapses because it is just virtually unsustainable. Now let's compare this chart with the S&P 500 and oh look, it looks suspiciously like a bubble that's already popping, isn't it? Now the crash is already happening. We are likely at a stage 1 of the crash where the initial meltdown is fast and furious, but it is still likely there's still much more room to crash. Now I want us to really understand the genesis of this collapse, how the greatest collapse has been engineered by the Fed, and the road to hell is always paved with good intentions. And this all has to do with the Fed stepping in to save the economy twice in 2008 and 2020 during the crisis by printing money to cushion the effects of the crashes, but in doing so, they just kicked the can down the road and inflated a bigger bubble. Now we have run out of road to kick the can to, and the implosion has begun. We can clearly see that the Fed went in and bought over $1 trillion worth of bonds in 2008 and almost $5 trillion worth in 2020. They rapidly increased the money supply, so now there are more dollars chasing fewer goods. But the real moral hazard is the low interest rate environment the Fed has engineered to stimulate the economy. You know, we have had around 12 years of near zero rates and this changed everything, right? Companies can now grow faster with cheap money and investors suddenly turn into speculators because now they can also borrow cheap money. I mean, why not borrow cash at around 1 to 2%, maybe even 3% and just plow it into the stock market that returns 10% annually, right? The stock market always goes up, right? So it sounds like a great deal until it is suddenly not. Now, the stock market is not a yield-generating machine that goes on forever, and now the Fed is really taking away the liquor, they are taking away the punch bowl, and that is why markets are collapsing. I really want you to believe your eyes and not the lies. Sure, Biden and his gang might be saying that the economy is strong and he has never been more optimistic, but I just want you to take a look around with your own two eyes, guys. Inflation is at an all-time high, credit card debt is skyrocketing, we are seeing asset prices, especially in the stock market, plunging down to hell. Now, every time we go to the grocery store, it really feels like Weimar, Germany, and a trip to the gas pump. It's like walking into a haunted house. You get scared shitless at the price just staring back at you. So we have energy inflation that's high thanks to problems on the supply side. The war in Ukraine is definitely contributing to this, but the problems were already structural, right? This happens when you push for green energy too fast prematurely and you neglect the oil and gas industry, which is truly the lifeblood of the economy. But the big tsunami or hurricane, as Jamie Dimon calls it, that's going to hit us is the deadly combination, the deadly combo of interest rate hikes and quantitative tightening. Remember that markets are down 20% even before the Fed has tightened and they have not sold their bonds yet, right? So let that sink in. So now we know the Fed is really going to start selling $47 billion of treasuries and mortgage bonds to the open market, and this will just ramp up to $95 billion a month, and they have over $3 trillion that they can sell. I want us to take a closer look at this chart. The Fed currently has $9 trillion on its balance sheet, and in 2020, they printed around $4.7 trillion to save the economy. So if the Fed decides to drain away $3.3 trillion through quantitative tightening QT, that is a drawdown of 70% of the funny money or 36% of their entire balance sheet. Now, that is an insane amount of money that's going to leave the system within 24 to 36 months if they decide to go full throttle. Now, we really need to think about the domino effect this will have on the markets, especially the bond market, and how it is ultimately influencing consumer behavior, right? The markets essentially were drugged up by easy and cheap money, and now it's all vanishing away, and the market crash we are seeing is the withdrawal symptoms. The markets do not know what is fair value anymore, and they are in a mad scramble to be priced. And from what we are seeing in the bond market, money is panicking out of the system. Remember that the 10-year yield is spiking, and that means money is exiting what was once considered a safe haven, right? And if you're a bond investor, you are getting clobbered as bond ETFs and funds are essentially cratering down to earth. Now, the 40-year bull market in bonds might have officially ended. You see that horrific red candle. That means investors believe that bonds are trash, and there's no other way to say it. Now, remember when I said bond market controls the stock market to a huge degree, and this is why. You see, the good times where companies were growing like crazy was fueled by cheap debt. Now, companies could essentially borrow money from the open market at low interest rates thanks to the Fed already setting the Fed funds benchmark rate to near zero. So all companies had to do was to offer just a slightly higher interest rate to get the capital they needed to grow. Now, all this is changing real fast because the Fed has raised and is raising the Fed funds benchmark rate and is dumping bonds onto the market. Suddenly, yields are going to go up. Now, in other words, companies need to offer investors a much higher interest rate to make it worth their while. So, for example, if the benchmark rate is around 3%, companies need to price their bonds at like 4, 5, or even 6% for investors to really take on the additional risk. And that means their cost of borrowing or the interest payments could double or even triple. Now, companies will find it more painful to borrow money to grow. They will become more conservative. They will pursue less growth. And this is why we are seeing stock prices just collapse. Now, the contagion of fear is really spreading after businesses themselves realize that a recession is coming and cheap money is leaving. We are seeing corporate debt just getting smashed and demand is going down because inflation is just that high, right? Just take a look at Microsoft's bond that was issued in 2020. It's supposed to pay 2.5% every year until 2050 when it matures. But at 8.6% inflation today, this looks like a horrible deal. And that is why you are seeing the price of the bond drop like a rock. So companies can't grow as fast, massive layoffs are on the horizon, and inflation is sky high. And this is where consumer behavior today has forever changed. The way we spend our money today is drastically different from just a year or two ago. So just picture this. On one hand, your paycheck isn't really going up. A 5 to 10% increase doesn't scale with inflation. And on the other hand, food and gas prices are going through the roof. Now, other than food, fuel, and your mortgage, you really don't have any excess money for anything else. And that means you'll be spending less on holiday trips, and discretionary products like a new car or maybe a TV. You'll be cutting away your Netflix and Spotify subscriptions, and you'll be dining more at home. Now, magnify this behavior across tens or hundreds of millions of people in America and across the world, and now you can see how bad this collective mindset will affect businesses and the economy. People are shifting away from excessive spending to only buying consumables and the essentials, and this just spells disaster for our consumerist culture. The only way for an economy to grow is that if there are more spenders than savers, and what if this dynamic reverses? And that's why we are already seeing a wave of layoffs across the tech sector. Now, Tesla is poised to cut 10% of its workforce, Coinbase is laying off 18% of its workers, and Carvana has axed 2,500 employees. Now, it's a bloodbath out there, and I really love to use the tech industry as a barometer of the chaos to come, because these are some of the most leveraged companies with pie-in-the-sky valuations that require cheap money to really fund their growth. Now, this is horrific news because this wave of layoffs could really start a domino effect that could snowball into a full-blown recession across every single industry, right? Housing prices could crash, manufacturing could grind to a halt, and the retail industry could suddenly go bust. So let's wrap things up in a nice pretty bow and get to the trillion-dollar question. Just how low can the market go? Firstly, I must say that no one on planet Earth, especially not the Fed, knows how low the markets can crash. It's anyone's guess. Now, the real issue is that the stock market can go much lower because we have truly never seen the bottom. Every time that the economy was about to go through the pain of a recession and a market crash, the Fed had to step in and save the economy with cheap and funny money. So if the S&P 500 bottoms out, it could easily be at 3,000 or even 2,000. But let us try our best to see how much downside is potentially left in this financial apocalypse. Now, I'm going to divide the chart into two parts. The first part is highlighted by the blue line that shows the organic growth of the S&P 500 if a financial crash was to play out and if there wasn't really any stimulus money in 2008 or 2020 being injected into the economy. Now, the second part is the purple line that shows us the current growth of the S&P that is being fueled by low rates and cheap money, which is abruptly coming to an end soon. As you can clearly see, it's a parabolic move up that is clearly unsustainable for long. Now, obviously, this chart is also quite flawed because we haven't factored in the true low of the 2008 crash if the Fed didn't bail out the big banks. So the blue line could be even lower, but let's just go for it for now. So if the Fed goes all the way and hikes rates and their QT removes all of this excess liquidity, it is not impossible for the markets to fall down to the blue trend line, the organic growth of the S&P 500. Now, I know that's very disturbing. We are talking about anywhere from the 1200 to the 1600 levels, and that is a 70% drop in the stock market. Very similar to the magnitude of what investors and stock market experts are calling the crash of the century. Michael Burry himself has called this the greatest speculative bubble of all time in all things. For the other scenario, let's say the market crashed towards the purple line, which is what I call the easy money trend, and that is still heading down towards 2700 or 3000 territory. We still have another 20 to 30% more to fall, which should really terrify us as investors. Remember that there's no true bottom or really strong support line or period of consolidation. From 2008 onwards, the whole system is running on cheap credit, and that credit is about to be pulled away. Now, obviously, please take this with a grain of salt. There's no telling where the market bottom can be. It could be higher or lower or somewhere in the middle. I'm just pointing out scenarios here so that we understand the magnitude of this crash and how bad it can possibly get. So right now, the trend is obviously down, and if you're trying to fight the trend, or as we would say, fighting the Fed, then you might be in a world of trouble. There's still likely a lot of downside left to go. So if you're in a market looking for cheap deals and you're holding on for years and decades, I believe there will be incredible opportunities in the months ahead. But the more disturbing thing is how long will this crash last before recovery? Now, looking back, it took around 4 years for the markets to recover from the lows of the dot-com boom and 5 years to recover after the lows of the 2008 housing crisis. But please remember that recovery was artificially induced by either low interest rates, money printing, or both. So we don't know how long this crash will recover. So if you're thinking of averaging into this crash, yes, you might be able to pick up fantastic deals, but know that you need holding power for the long term, because after you click that buy button, it is highly likely that the market will slap you on the face and continue to plunge again. But obviously, this is just a crash scenario. Everything can suddenly reverse if a confluence of events happens, if the war suddenly ends and energy prices come back down, plus the Fed stops the rate hike and starts printing money all over again, then we can truly see the markets rebound and even make all-time highs. But as it stands, I find it really unlikely, because even the Fed knows that doing so will just kick the can down the road and possibly trigger hyperinflation. If they fire up the printing presses once again, I won't be surprised if double-digit inflation is here to stay. So I really hope that you do your own research as well and listen to both the bearish and the bullish cases of this market crash. There's still some market experts out there who believe the markets are just in a correction and things will bounce back, but at least to me, from what I see around me, I think we are still in for either a long bear market or horrific crash. Obviously, this is one of the toughest environments to be investing, and if you're in the red, I understand the pain of seeing your entire portfolio get decimated, and if you're a crypto investor, you are probably feeling even worse. But I think the biggest lesson from this market crash is how foolish it is to think that markets can continue to rise and rise without end. And if we were to be honest with ourselves, the signs were everywhere. Crypto companies suddenly giving out 10 to 20% yields on their lending schemes, and people on the streets calling out for Tesla to go to the moon. You know, there's a very good saying back in the 1930s that if the shoe shine boy starts talking about stocks, perhaps it's time to get out of the market. So really calm your nerves and try to think straight and logically. And if you're still mentally paralyzed, sometimes the best thing to do is absolutely nothing and just watch the chaos play out. And if this is your first market crash, you are watching the popping of an epic bubble that was decades in the making. So let me know what you think in the comments below. Don't panic, stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe for more videos as we navigate through this economic insanity. Thank you guys for watching, and I'll see you soon.